a very memorable commercial during the dot-com boom where some stockbroker is broken down on the side of the road and wearing a suit and tie undone, and a truck pulls up and he says, "Oh, thanks a lot." And he's reading Barron's magazine. "You're in the market?" Kind of arrogantly. "Yeah, I dabble a bit." He's trading on, goes, "Oh, what's that you got there?" It's a picture, it's an island I bought. It's really a country technically, and I just do this for fun to help people out. So, the truck driver who, started trading stocks made enough to buy an island, was way wealthier than the arrogant broker who was broken down on the side of the road. So, and there are many commercials like that where you can do it, you can outsmart people, but that's very tempting to people because the stock market seems very easy, and you don't really need a lot of IQ to do well in the stock market. It isn't that complicated either, because you don't need to do all the analysis. You can outsource it. It's never been cheaper or easier to outsource things, and or to just buy a bunch of ETFs and forget about it. That's a beautiful strategy. You'll beat 85% of people if you buy a bunch of index funds and forget you own them, or check them once a year, every few years, and reinvest the dividends. But they make no money. And so that's the irony, is you can beat Wall Street. Like, if you really don't like Wall Street, I don't dislike Wall Street. I used to work on it. I work at the Wall Street Journal. They buy all the ads in the newspaper, my newsletter. Wall Street's good. They put food on my table. I don't like or dislike Wall Street, but if you really don't like Wall Street, the way to really hurt it is to take part in this revolution of investing being very cheap and very easy, where they're making, just 0.03% on your stock fund. They don't make a lot of money on that. And so they have to create products and excitement to lure more people in. One of the many ways was these app-based brokerages that got people to be very active, because even though they paid no commission, they were paying. They were paying indirectly.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable, quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. After 20 years of investing, I've seen countless research tools come and go. But Fiscal AI is different, and it's become indispensable to my process. Fiscal AI is a modern data terminal built for investors who want institutional-grade research without the complexity. Whether you are a retail investor or managing a portfolio professionally, it gives you instant access to 20 years of financials, earnings, transcripts, and an extensive segment and KPI database, all in one intuitive platform. What makes it a game changer? Speed and depth. Their data updates within minutes of earnings reports, not days. Want segment revenue, subscriber growth, It's all there, easy to chart, compare, and export. I use Fiscal AI daily to research my holdings, find new investment ideas, and deepen my analysis. It's fast, intuitive, and has genuinely transformed how I work. Use my link, see episode notes, for 2 weeks of free trial plus 15% off. My guest today is Spencer Jakab, an award-winning investing columnist at the Wall Street Journal and author of The Revolution That Wasn't, GameStop, Reddit, and the Fleecing of Small Investors. With 20 years of experience as stock research director, financial journalist, Spencer brings a rare insider-turned-critic perspective on Wall Street. His latest work dissects the meme stock phenomenon, not as the democratizing revolution many claimed, but as a cautionary tale about human psychology, technological manipulation, and how the little guy once again got fleeced while believing they were sticking it to the man. Spencer, how are you? So nice to see you.
I'm well. Nice to be with you, Bogomil.
I'm really excited for this conversation. I mentioned to you, I loved your book, and the topics we'll talk about, those things happened a while ago. I had an idea of what happened, but your book gave me a much more complete picture of actually what happened. And as I mentioned to you, I don't think what was happening back then is over. I think it's part of our reality these days, and I think it pays to notice and acknowledge and maybe be aware of some of the things that are happening. Before I ask you about the book, I'm curious about the early days. I know a little bit, we spoke before, but I'm curious about the early days, childhood, upbringing. How do you think that time shaped you?
Well, it definitely shaped me. And I'll make a very slight correction. It's 30 years of experience.
There you go, 30 years.
I'm old. That's why I look so old. It's not Liberation Day and writing columns that age me that much. It's being, the number of years. Yeah. So I'm a financial journalist now. I have been one for 22 years, 23 years, I guess now. I started out in finance, and both of those careers really happened by accident. I didn't know anything about either one of them. I knew that people wrote newspapers. I knew that there were banks and stocks, and that's about all I knew. And I got into both of them in a very roundabout way. My parents were Hungarian refugees. I grew up in Queens in New York. And of all those people, my dad actually was the only one who was interested in the stock market. He was very interested, would talk to his friends all the time about it. And they're like, yeah, sounds great. We wish we had some money to do all these things. But he would try to talk to me about it. I really was just maybe he wasn't very good at explaining things, and I wasn't very good at understanding things. And I never caught the bug while he was alive. He passed away when I was a teenager. And then when I was in college, and I heard you say that this was the first book that you read about investing as well. You said you picked it up in a bookstore in Brussels in another podcast. Went up on Wall Street by Peter Lynch, and I was just in the university bookstore and walked by, and I guess it had just come out in paperback, and we're picking it up, and it's one of those things where an hour has passed and you're still sitting there reading the book, and so might as well buy it. I'm a third of the way through, and I found it so interesting, and it was such a clear explanation of how to invest, which really makes it a great book. I mean, I didn't know who Peter Lynch was. Had I known, I think I would have been even more interested, given his amazing track record. And that was around the time that he retired, at the kind of the top of the world as a mutual fund manager. And then I didn't take any business classes, but I read a few more books in the next couple of years. I met a kid, he's now a 61-year-old kid, we're still friends, who had been an investment banker. And I wanted to go and be a historian or something like that. And, I just, excuse me, I just excuse my ignorance, but I've heard that term, but please explain it to me. And, he described it as terrible, that you have to work, 80 hours a week, and you just do whatever people say and get on a plane at a moment's notice, and that he had made $80,000 a year. This is, I guess he graduated from college in 1987. And that stopped me. I was like, wait, what did you know how to do? And he basically told me, we were at Columbia University, take all the classes you can. You were allowed to then at Columbia Business School, all the accounting and finance classes. And since the Iron Curtain just fell and you're bilingual, they're going to be privatizing everything. And you can get a job. And I was extremely interested in the transformations going on in the region. I knew that history was being made. I would have loved to be a witness to it and be part of it. And I decided that was what I was going to do. And so I did every single thing possible to learn about finance, read about it. Someone told me, "Oh yeah, I didn't get an MBA," but he said, "If you read the Wall Street Journal cover to cover every day, that's like getting an MBA." It's not totally true, but I did that, and I really loved the subject. I found it fascinating. I understood why my dad had been so interested in the world of investing, and I'm still kind of a junkie for it. And then I went to go work as a country analyst for an investment bank, and then eventually rose to become head of a research team covering all those markets in the entire region. And then I got bored of management and said, I'd love to write about this. I love talking to people about it. I feel like I have enough of a financial cushion now that I can do what I really want to do. And wound up sitting on a plane next to an reporter for the Wall Street Journal, who was their editor for the whole EMEA region. I lived in London at the time. And she just asked me, "Have you ever been interested in financial journalism?" And I said, "Yeah, as a matter of fact." 2 days later, I was in the newsroom. She invited me to a morning meeting. There was something that the people there didn't know, and I piped up. And they said, "Who are you?" And we had this writing test that we give. And I said, "When's it given?" So we can give it right now. It takes 2 hours. So I took the writing test. I always enjoyed writing. I always felt that was a strong point. I was kind of a hyperlexic kid anyway. I read a lot. And that afternoon, I was working for her instead of in finance. It was a big pay cut. And so that's been my journey to this path. And, I think working in emerging markets really makes you cynical. It gives you a lot of experience because it's not like being an analyst in New York or London where the companies hand everything to you on a silver platter and you're really kind of kowtowing to them. It's a different kind of analyst experience where there really sometimes there's no information that's apparent. Certainly was no internet when I started. And so you have to find things out. You have to speak to people. You have to do a bit of a detective, and you can call them like you see them too, because that's what clients want to know. The clients are the investors, not the companies. They're governments that you were privatizing things for sometimes, but basically you were an actual analyst, as analysts are supposed to be. And, and then I just got burnt out on it. But I think that having seen all these crises, and every 2 years something crazy happened in one region or another, it makes me much more wary, much more skeptical of what's going on today in developing markets, the ones that I write about every day for the Wall Street Journal. And right now, at the beginning of this year, after running the Herd on the Street team for a decade, I decided to take on the writing of our new daily investing newsletter, Markets AM. It's got, I guess we're approaching 500,000 readers, so it's
Wow.
going very well in terms of readership, and the audience is really the educated layperson. There are a lot of people like you on Wall Street who say they read it and like it and find it thought provoking, and I think that's great because it's a difficult needle to thread in terms of writing something that might be interesting to you, but something that isn't completely confusing to someone who's been investing their own money for 30 years but isn't well versed in finance, might have to have EV/EBITDA spelled out for them or something like that. You don't want to baffle people; you'll lose them. And so that's who I write for now. It's harder to do that than to write an analyst report where you can use all kinds of acronyms and abbreviations and shorthand. But it's a much more satisfying audience to write for. Unfortunately, not as lucrative an audience to write for, but that's okay. You can't have everything.
That's a huge number of readers that you talk about, and it's wonderful that you found a way to explain things. I think, in our profession, we might think that the goal is to use all those complicated words and notions, and then nobody knows what you're talking about. I think there are moments where I turn around and I sit down with a client and I have to explain what's happening in the portfolio. And it's that moment when I have to realize I have to use a different language. And they're very, well-educated, competent people, but they don't live and breathe the world than you and I do. So I have to explain things. And I like the way you go about it. I think more people are looking for a way to be informed and not confused. And I think that's very helpful. I have so many thoughts about the things you brought up. Investment banking, I was supposed to accept a job like that, and somebody talked me out of it last minute. So I went into the investment management side of things. The pay was not the same, but the satisfaction, to me at least, was higher. I want to mention quickly the bookstore experience that you talk about. Somebody posted a photo of a bookshelf in a bookstore, and I was looking at it this morning, and I'll make a confession. I went title after title. It's a bookstore somewhere at the airport somebody saw. And I was going title after title, like the old school style, looking up those books. What are they? I miss bookstores. I miss that experience of standing in front of all those books and choosing what to read next. But anyways, bookstores introduced you and me clearly to a lot of wonderful ideas. Quick thought about emerging markets. A lot of people ask me about international investing. I'm US-based, US-centric these days. It makes my life a lot easier. For me, the hurdle is so much higher when I look outside. And I think you and I have seen things and understand things that sometimes if you're far away from a place, the grass looks greener, but there are a lot of things you just don't know unless you're local, or you'll make yourself very local by staying in the place for a long time to understand what is exactly happening. So for anybody that thinks that international investing or emerging markets investing is easy, no, I have a lot of respect for people that do it full time and they're really in it deep and they know what's going on. I want to ask you about the story that you brought up with me before I asked you about the book. You told me about your mom, and I hope it's okay to bring it up.
Sure, yeah.
She bought shares in Amazon. No recommendation of any kind, of just a beautiful case study. She forgot that she bought them. And at some point, they called her and she found out, and you had to do the paperwork to figure out how to pay taxes on some events in the account. Anyways, can you bring up the story? I find it fascinating because there are those tales of forgotten money, forgotten stocks, and forgotten accounts. This is the story.
Yeah, my mom. I mean, I told her, I guess when I started in the early 1990s in the investing business, I said, do you have investments? And she had maybe in the late 80s, finally had some money to save and begun to put money into account. That she had an advisor who she was paying a lot of money to. And I said, yeah, Mom, there's this thing called Charles Schwab. You can open up an account there. And this was $30 to trade a stock, which seemed very cheap then compared to what this guy was charging. Like, you don't need to, I'd read all these books. I'd read Random Walk Down Wall Street and, all these other books at the time. And listen, you don't need to pay this guy. He doesn't have any expertise. Just to do it yourself. If you have picked 15 stocks that are not all in the same industry, you're basically statistically diversified. I guess there was, I didn't know about index funds or didn't tell her to buy an index fund, but so she bought a bunch of stocks and then she got very, very into it. She and her friends, and this is kind of a teaching moment too. This is a real kind of classic sign of a bubble. She and her friends got very into the stock market as she was, kind of near retirement, and some of them were retiring, and she was watching 4 hours of CNBC a day. This is in the late 90s heyday. So I have 3 sons. My oldest son was born in 1999. So I can't remember exactly when it was, but he was a baby. I was holding him in my arms. He couldn't walk yet. This is months before the crash in the tech stocks. I personally was very skeptical about it. Most people at work were not, but I was scared to death of what was going to happen. And I'm home in Queens from London, holding the baby. There are these middle-aged Hungarian ladies, you're holding a baby. It's like meat in front of a lion, right? I mean, you expect them to sort of be all over him. And they were, but then they stopped because they knew that I was the only person they knew who worked in the investing business, asked me all kinds of questions. And I gave them my whole speech about being cautious and not owning these tech stocks. And they were telling me then it was, they were lecturing me about how much money they'd made in Lucent and some internet incubator and all this stuff. And they didn't even know what the companies really did. I mean, they're not dumb people, but they didn't, they're not smart in that way. They didn't really know what they were doing. They just saw someone recommend it on TV or read about it somewhere. And they all were kind of sitting on small fortunes in their accounts. And my mom was too. And so after they left, I asked to see her account. Let me see your account right now. And it had mushroomed in value. She had basically bought everything that if she liked someone on CNBC and said, "Oh, I saw a young man who looked just like you, and he recommended this internet incubator, and he was so smart, and she had made an absolute, she had no idea how much money she had made."
Yeah.
I said, and then she had some other stocks that I told her just years earlier to buy too, that were like, normal, like, all
Yeah.
Philip Morris, which she still owns, all the offshoots of that. That's the stock she's made even more money on than Amazon, by the way. But yeah, and so I said, you have to sell all these tech stocks right away. This is going to end very badly. And so it took a lot of convincing. She did it. She put them into bonds and other conservative investments and utilities and whatever. And, then like a few months later, it still hadn't crashed. She called me like, "Do you know how high Cisco is now?" I said, "Mom, you buy it back if you want." Like, no, I trust you. So that was a stroke of luck that we had that conversation. But then she had opened in the meantime another account, that she totally forgot about. She had an old AOL internet address, and she had like, I don't know, a few $1,000s in her checking account, and her best friend had told her that, you could trade stocks online. I guess she wasn't doing it at Schwab, whatever. And so she opened an account at Ameritrade, and and then she bought 2 stocks, and she never told me about it, and she forgot about it, and she moved, and she never checked that address, and it was still alive somehow. And then the other stock, there were no dividends, and it was bought by some other company. It was some medical device company. And she said, I do her taxes for her. And she told me like, "Hey, I got this letter in the mail from Ameritrade. I didn't even know I had an account." I was like, "Okay, that's good." And what was the other stock you bought? And it was Amazon in 97, 98. I don't know, like, so she had basically lost 90% of her money in Amazon, and then probably 80% at a later juncture in Amazon. Like, definitely, most people would not have held on that long. Most people would have panicked near the bottom, or when it bounced back, and once it doubled, sold again. And it was worth more than her apartment. So, it's one of those stories. There's some apocryphal one that I've heard several times. It's not true, about customers at Fidelity who are dead, whose accounts perform better than other people. It's not, I checked, and it is not true, but it's a great story, and it would be true. Because that is the key to act like you're dead. Yeah. So that's her Amazon story.
Forgotten money in a forgotten money in a forgotten stock. Remind me if I'm correct, but I think you told me that you actually reached out to some people that recommended or liked or talked favorably about Amazon when it collapsed. And I want to bring it up because I came across a lot of people over the last 2 decades of investing that bought the right stocks at the right time and even at the right price. But there's a secret: they haven't held them long enough. So you reached out to some folks that liked Amazon and you thought that they're probably billionaires by now, but they're not. Can you tell that story?
Yeah. So early on, when I was writing my first stock market column, this is before I went to the Financial Times, I was left on my own and could write about anything. And I'm like, let's think of the next idea to write about. Like, let me find, it wasn't Amazon, it was tech stocks and energy stocks after Enron collapsed, like Dynegy and things like that. Let's find people who spoke favorably about companies that almost went to zero and then turned around, and they made, you would have made, if you had bought at the right time, 100 times your money or something like that. And yeah. And so I looked up all the articles around that time, people who mentioned them. There was always at least one fund manager who defended it, said they owned it or had bought more. And I looked them up. They were surprised to get my call. Like, there were these like small fund managers. And listen, I just wanted to congratulate you on buying, Dynegy when it was 2 cents or whatever it was, and how did it go? And every single one said, well, I wish I had kept it, but it doubled and I sold. So it's very, very, very difficult to hold on to things. I know that you've spoken on other your podcast, which I'm an avid listener of, with Chris Mayer, the author of 100 Baggers. And I mean, that is really the sort of, knowing when to sell, when not to sell. That's harder than buying. It takes a lot of discipline. It's actually funny that the book, when we get to talking about it, you don't think of him as any kind of a investing savant or whatever, but the guy at the center of the story, Roaring Kitty, whose actual name is Keith Gill, and I won't use the other name that he used online because I guess this is a PG-rated podcast, but that guy who was at the center of GameStop mania actually bought very, very low and sold at the perfect time, like to the day, almost the perfect time, which is kind of incredible. But you very rarely see that or hear that.
Well, speaking of that, you were looking at those stocks that collapsed. There were quite a few stocks that people fell out of love with and were not doing well. And they became this wave of stocks that got the attention of a handful of people. It wouldn't matter, but the numbers were so big. So many people joined in, even with little money. And they created this revolution that wasn't. Can you set the stage? Because I feel like what we talked about brings us to yet another moment, 20 years after the internet bubble. Yet again, this promise of easy money. And I think a bigger promise of proving something to the big institutions. You know, the little guy can finally fight back.
Yeah, I was sitting in this very spot at this very table, and everyone was home because it was COVID. My oldest boy was home from college. My middle son and my youngest son were around, and he came over, my oldest boy, and said, "Dad, are you going to write something about GameStop?" And I had, obviously taken the three boys. I'd taken them to GameStop physically to buy games and trade them in. They knew, and I knew that it was a dying business because we didn't go there anymore. You know, it was this business that was kind of going the way of Blockbuster Video because technology had passed it by. They made all their money, kind of ripping off little kids by buying their games at a discount and selling them more expensive games, and this whole trade-in business, that was their whole margin. And it was, closing stores and in big trouble. But there was some value there. There were some value investors who saw the potential for a turnaround, and it was very cheap. And then COVID happened. And when COVID happened, you had literally millions of new people coming to the market, most of them young, overwhelmingly male, between the ages of 18 and 35, opening brokerage accounts. And you had this confluence of different events that made it very exciting and very possible for them to get into the stock market. One was that in late 2019, just shortly before COVID, every single discount broker went to $0 commissions. And you'd say, like, well, what's the difference between $5 and $0? It's just $5. And that's not a big difference to you, but it is a big difference to them. If they had $100 in their bank account, they're not spending 5% coming and going. And psychologically, it's a gigantic difference, as I explained in the book, because there's this, kind of zero cost effect, where with something, obviously there is a cost to trading still, which they're not aware of, which is the bid offer spread and all the frictions, but that's not advertised. The fact that it costs nothing makes you use something much, much more. It's like the fact that we're having this conversation and I'm not spending money on a phone bill and you're not spending money on a phone bill. You and I, this podcast won't go on for 8 hours, but I can talk to my friend for 8 hours halfway across the world. There's no cost to it. And I do it a lot more than in the old days when you had to pay money, even if it was a little bit of money. It just psychologically, trips a wire in your brain. And it did for all these young people. You also had a boom in sports betting. It was legalized a couple of years earlier. It was already illegal in more than 40 states. And then all sports went away briefly at the beginning of COVID. And you had all these people who were kind of, basically addicts, either doing fantasy sports or outright betting, and they were looking for something new to do on their smartphones. They were very bored because they were also sitting at home in mom and dad's basement or in their apartments. They had a lot of extra money. Their student loan payments were halted. They got stimulus checks. They had enforced savings because they weren't going out with their friends or going out anywhere. And so, suddenly, and then you had this really exciting thing happen, which was stocks collapsed. For you and me, stocks collapsing is a terrible thing. It's a terrifying thing. You see, a third wiped off of your net worth or something in a period of a few weeks. It doesn't make you want to go out and buy more stocks. Probably you should, but that doesn't. Most people do the opposite. They sell or they're paralyzed with fear. But it was very exciting to them, that period in February and March 2020. And you had a lot of people, Warren Buffett and others, who were extremely cautious. Warren Buffett sold all of his airline stocks with poor timing. I mean, he's a world's greatest investor, but he did not get that one right. He's not a market timer. And the fact that he sold, yet if you had basically bought a basket of airline stocks, you made, I think, 90% in 3 months from the bottom to June, lots of things like that taught these people that listening to serious people in suits was dumb. listening to influencers on TikTok, or people strangers you met on Reddit was smart. And so, you had this boom in social media, this boom in investing, and that laid the groundwork for GameStop and the other meme stocks to take off. But the spark that really made that one in particular take off was that Wall Street also happened to be very skeptical about it. And there were a handful of stocks. I mean, if you wanted to short Tesla, or let's say Nikola, which turned out to be a fraud, or all these other companies, it made perfect sense on paper, because they were very expensive, or in some cases frauds, or people were shorting, bankrupt companies like Hertz, right? Went bankrupt. And yet you had all these meme stock traders buying them. And so it was very dangerous to short these obvious battleground stocks. But they felt very safe shorting kind of dowdy companies that no one ever thought about. They weren't glamorous, like GameStop or AMC, the movie theater. But what those stocks had in common was they're very dowdy. And so you had these hedge funds, mainly long short hedge funds, who were shorting them. But they also were part of these young people's childhoods, GameStop and AMC in particular. They were parts of their childhoods, and they conflated short bets against those companies with someone attacking a part of their childhood, as opposed to just making a normal financial bet. Yeah, and so you had GameStop is the one whose numbers I remember. It's been a few years since I wrote the book, but GameStop went from $2 a share in March 2000 to as high as $480 a share, 484 something, I think, and change, in late January 2021. And most of that happened in a very short period of time. And it was a coordinated movement to push it up, because this company was being attacked. And to these young people, this is one more element, these hedge fund investors were cartoon villains. Their formative financial experience had been their parents or their neighbors losing money, or losing their homes, or losing their jobs during the financial crisis, when they were teenagers or preteens. And so to them, these were bad guys who deserved to be punished. Here was a way to punish them and possibly make some money. And then you had people who just wanted to make money, who weren't idealistic about it. You had a whole mix of people, but everyone piled in. You had the membership of Wall Street Bets, was the main place that this was being organized, jumped to 8 million people in a matter of weeks during the whole episode. And what they were doing, and that's what fascinated me, is I was sitting here, my son asked me about it. He told me his friend had bought it, is that they were instituting a corner on the stock market. I'm a student of stock market history. I know that those used to happen all the time before securities laws were passed in the 1930s, but they hadn't happened since. Yet this was a totally legal corner because it was just coordinated on social media, out in the open, in a place that no one on Wall Street went, which is, this dumb message board on Reddit that changed the world, right? And so they were talking about Gabe Plotkin. They were talking about all the characters involved. They knew how much short interest there was. They were looking at securities filings, and there were a few people on there, I think, who knew what they were doing, who were trying to stir the pot. I think who positioned themselves to make money, who weren't 23-year-olds living in mom's basement. They were they were pros, and they taught people about a gamma squeeze. They taught people how to use options to magnify the impact of their portfolios. And it was all possible because these brokers allowed you to do anything. Basically, they allowed you to buy options, with no experience. They made the process way too easy. And so, it was a perfect confluence of events that caused this explosion. When I first heard it, as you said, like you saw it a different way too, and I saw it a different way. When my son came here and told me about it, 10 minutes later, I emailed the acquisitions editor at Penguin Random House. I'd written a book for them before about investing, and it was a new person who didn't know me, and she said, "Oh, I haven't heard about that." And I said, "Well, you will." I said, "Well, do you have a proposal?" I said, "No, this is literally happening now. You're going to be hearing about it in the coming days. It's, hedge funds are going to lose billions of dollars, as a process, as a consequence of this." And I thought it was this David and Goliath story too, initially, but then, the more I thought about it and the more it played out, I took a more nuanced view.
Fascinating time. The story you're telling is so much richer than what I learned at the time, especially with why those young investors decided to go after this particular segment. For the benefit of the audience, why does it make sense to go after a stock that's sold short, has a big short interest, and how does that work? And these investors might have been young, but they figured out a weakness,
Yes.
and they went after that weakness at that time.
Yeah, I mean, it's funny, and people, when something like this happens, it's often a reference. And what's one of my favorite films is Trading Places. People will reference that movie, where
Yeah.
you ambush these rich guys who no one likes, and that's what I thought at first too. And then within hours, I thought, it's like if you've seen the movie Zulu Dawn, which is when these, British imperial soldiers in the early 20th century are massacred by a bunch of spear-toting Zulus. I mean, they had some guns too, but it's a true story. They were very arrogant, and even though they had the cutting edge everything, they lost because they were overwhelmed by superior numbers and audacity. And then I thought, no, it's like Revenge of the Sith, the third of the awful prequels in the Star Wars series, where the Emperor wants to see this fight and he engineers this war, but he just wants to see the fight. He doesn't care who wins. I mean, he doesn't care if Count Dooku gets killed, even though that's his guy, because he is benefiting from the existence of the fight, and the Emperor is like Wall Street, and this is a very, very profitable moment overall for Wall Street. So there were a few hedge funds that lost a lot of money, but Wall Street overall, it was a bonanza, and that's why it wasn't a revolution, is because you actually enriched Wall Street through these actions. But to just take a step back, because you asked me to explain, when there's very heavy short interest in a stock, when a very high percentage of the shares that are available are sold short, and it is possible for more than 100% to be sold short without criminality being involved. It's called rehypothecation. It's possible for those shares to be sold short, where you go to your prime broker, if you're a hedge fund, and say, I want to sell the stock short. Can you locate shares for me? And say, yes, I can. And then you sell them. And then you sell it to whoever is buying those shares. The person has the shares. They don't know the short seller sold it to them without owning them. And then their broker might take those shares and say, hey, you have this stock lending program, so we're going to borrow those shares, so they can get borrowed twice. And in the case of GameStop, it was, I think, 143% of the free float was sold short, which is very dangerous. And the danger there is that normally for investors, and I don't recommend short selling for any individual investor at all, and this is why, is because your losses are theoretically unlimited. A stock can only go down to zero, but it can go up to infinity. And what typically happens this is a short squeeze, is that the stock goes up, these people start losing money, they get calls, and they have to put up more margin, and they say, screw it, I'm gonna cut my losses and buy the stock back. But then they're piling more pressure onto the wave of buying. And that's what these people figured out, is you could create a short squeeze and you could amplify it through these sort of financial weapons of mass destruction. For example, by buying very, very cheap options. If you buy a stock option or call option, which is the right to buy in the future a stock, if the stock is $100 and the call option expires in 5 days and it's at $105, well, it's unlikely. The odds of it reaching $105 are quite low. So you can buy that option, but people will sell it to you for pennies. So you can take lots and lots of pennies and buy options controlling lots of shares. But once it starts to rise, and especially if lots of people online are piling into it, then the options broker, they don't care. The options dealer needs to purchase the shares themselves as a hedge. So they exacerbate the squeeze. And that's called a gamma squeeze, where the more rapid rate at which it rises before the expiration date, the more shares they need to buy. And it becomes the self-fulfilling thing until it doesn't. I mean, of course, it eventually, runs out of gas, as it did in the case of GameStop and the other game stocks. Things don't go to the sky, and that many people didn't understand that. If you look at the messages on the message boards, they thought that things would just go up forever and they would bankrupt the financial system and all kinds of, if you type in hashtag MOASS. Go ahead and do that at your leisure, and you can read lots of conspiratorial stuff about how that's going to happen. MOASS is going to happen. I think it's the mother of all short squeezes, where they're going to bankrupt the entire financial system and then have all the money. So yeah, I mean that was the kind of extreme version of that theory, and at that moment, they weren't talking about that. They were just talking about bankrupting many hedge funds, without realizing that the discipline would break. They're not like my mom, who forgot that she owned Amazon. They knew that they had made some money or were losing money or whatever. And so, when you have a online army that's been organized over the period of several weeks, that they're not all going to stay in line. Some of them are going to break ranks, and we're just in it, for a lark.
Some fascinating things were happening, and you bring up January 28th, 2021, when the trading was halted. And I actually remember that day. I wasn't even paying attention to that phenomenon, but I noticed it's not that often that a trading is halted just like that. And a lot of people thought that, there's a conspiracy theory behind it. But you argue that Wall Street had reasons to circle the wagons for mostly technical reasons. It was just way too much happening all at the same time, and they had to figure out how to. But anyways, I'll let you tell the story. What happened then?
Sure. I mean, this is probably the least exciting part of the story, but the most controversial part of the story, because people will even people maybe not in the business, but people sort of who follow finance will. But isn't this true? But isn't it strange? Isn't it a coincidence that this? Yeah, it is a coincidence, but coincidences are coincidences. So what happened was that there was so much buying. So many people were opening accounts. So Robinhood in particular, which was the broker at the center of this, which wasn't a publicly traded company at Robinhood Markets, they were allowing people to basically open an account, and then even before their funds had settled, to start trading right away. Because I'm going to stereotype for a second. You're sitting in your friend's dorm room and doing a bong hit, and they're like, dude, you should really open a brokerage account and do this thing. And you do it on your phone and deposit $241, which was the median size of the account. Yeah. Not a lot of money. And then 3 days later, you kind of forgot about it, or you're kind of on to the next thing. But if you can trade right away, sitting there in the dorm room after doing 3 bong hits, then you're going to do it. And so they basically fronted customers the money, which is not a totally dangerous thing to do, but it basically allowed people to open millions of accounts in a very short period of time and start affecting the market without the money existing yet necessarily at the broker. It was just on the way. Funds take a while to settle. And when you do a trade, T+2, it takes a couple of days to settle as well. And so there is a clearinghouse, which is a government entity that looks at these things and tries to ensure the integrity of stock and options markets. And they looked at this surge of activity where everyone was going in the same direction, not two directions, the same direction on the same 13 or so stocks, mainly GameStop and AMC, but other companies as well. Several companies went through the roof, and they're saying this is totally in imbalance. And so they went to Robinhood in the middle of the night. And they said, okay, listen, you need to put up some margin, $3 billion to be precise, which they didn't have. There's no way that they could raise it in a few hours. And so Robinhood drew down its credit lines and said, listen, if we halt buying, not selling, but if we halt buying in these stocks, can we reduce the amount? Because they were going to be insolvent, which would have been the same result for their customers, by the way. The broker shut down. And it would have been, weeks before they could access their accounts. The broker would have been shut down by the authorities. What happened was that they were just not able to purchase any more of these stocks. That anyway, that was the peak. That day was the peak. In GameStop, it went up a bit more to that mid-morning and then collapsed. And so there's this theory that Wall Street kind of stabbed them in the back and stopped this thing from happening, and they were finally going to win, and then they had it snatched away, which is not what happened. But there are other things, there are other coincidences that make it sound very suspicious. And one is that Gabe Plotkin, who was the hedge fund manager who lost $6 billion in a matter of a few days, his fund Melvin Capital was at the beginning of this, it was a $13 billion hedge fund, he didn't say, he didn't like the word bailed out, the words bailed out, but it was bailed out by a couple of different people. One of them was Point 72 Chairman Stephen A. Cohen, and the other one was Citadel, the hedge fund, Ken Griffin. And just over the course of a phone call, they gave him billions of dollars at, very much in an advantageous way to them. They're kind of predatory lenders in a way, but they took, revenue stakes in the hedge fund to shore it up so that he wouldn't blow up. And Citadel also owns Citadel Securities. Citadel Securities is the main market maker for all these discount brokers. It's a different business. The businesses don't deal with each other or talk to each other. It has the same name though, and it has the same majority owner, which is Ken Griffin. And so the fact that Citadel, first of all, Citadel would be crazy to intervene on its, and in terms of its own interest, Citadel Securities, because they were making so much money during this period. It later emerged that they made a record profit during that quarter because they are the ones that make these brokerages with very small clients, but lots of frenetic activity profitable, because they pay them for their order flow. And the more frenetic and the more reckless the order flow is, the more they pay for it because they can make more. They're clipping fractions of a penny off of all these stock and options trades. And if you have clients who trade a lot, who don't put in limit orders, who like buying options, who buy more thinly traded stocks, not the big names that have very tight spreads, they love you. And they paid more to Robinhood than to anyone else because Robinhood those were their kind of customers. And so they weren't shooting themselves in the foot. It was Ken Griffin, the owner of the hedge fund, who was being opportunistic and bailing this guy out at the same time. He already had actually exited his positions in GameStop, so it had nothing to do with it. But it all sounds very suspicious. And that congressional hearings were called that day because people on the left and the right were outraged. So it turned into a political thing. You from AOC to, I don't know, people on the, I'm forgetting their names, senators on the right. Basically, the whole political spectrum, everyone was angry at Robinhood, and there was a person who was at the center of all this, whose name was only revealed at the end, who was kind of an inspirational figure, really, rather than an architect of the squeeze. Keith Gill, aka aka name I'm not going to say, his moniker on his name on Reddit. Who was the inspiration because he saw the value in GameStop, and then took a $55,000 bet, basically all of his net worth, and at the peak had well over $30 million just riding on GameStop because he bought options. So he was also called to the hearing, but they weren't very mean to him because he was sort of a folk hero. They should have asked him more questions, frankly. Just about the whole phenomenon, because I think it would have been enlightening, but they didn't. So they missed their opportunity. They really assailed, the people who stopped the trading, which was not, they were not really, they're villains in another way, in the sense that they got really rich off of the naivete of young speculators, but not because they stopped them from buying more GameStop on that specific day.
I have vivid images of the 1990 period in the internet bubble, and I was watching some financial news, and they were showing a truck driver who just quit his job to trade stocks daily. And I've never heard of a concept, and it never crossed my mind that one can quit a job that seems to be stable and in his profession with his skills and trade stocks on, I guess it was online already at the time. And I remember watching it. I couldn't understand what's happening. Anyways, 20-some years later, a quarter of a century.
But Bogomil, the great thing about the stock market is you can own stocks and they can make you money while you're driving the truck. You can do both. You can be a multitasker, right? And you'll do better if you don't trade them frequently. There's a inverse correlation between activity and returns.
I think the best investing lesson here can be taken from your mom. Buy what you know, forget about it, and let it be. And it's the same stock market. When I was learning about investing, a lot of my professors, I'm pretty certain right now, lost a lot of money in the internet bubble. And Amazon, out of many stocks, was the one that really stirred up a lot of emotions when we would bring it up. and they were telling me that Amazon is just it's the worst of the worst. It has no future. When the stock went from 106 to $6 or something like that. Anyways, clearly they were wrong. Amazon survived. It became what it is today and reinvented itself many times over. I think there's so many lessons here because the stock market as such can be a casino if you want it to be, but it can be a place where you can go and buy quality businesses and hold them over a long period of time too. And it's confusing because it seems like it's the same place. But for me, the stock market can close for a year. It has no bearing on what I'm trying to do. For these young speculators, the market couldn't even close for half a day or however long that hold was. I don't know. There's a lesson there. I want to ask you about human psychology. Mm-hmm. It hasn't changed in over 50,000 years. We talked about it. You write about it. Can you explain how the hunter-gatherer brain had helped us survive, avoid lions, and brings us here, and we fail?
Yeah, I mean, this brings us to, I suspect that your listeners are mostly familiar or have heard of prospect theory or various things, but the GameStop episode actually took it a step further. I was very familiar with it, yet there were aspects that I was not familiar with. I learned a lot about social psychology, about the more subtle aspects of social psychology in researching and writing the book. So the basic thing is, if you're in Paleolithic times and you're sitting there and you hear a rustle on a bush, mm-hmm. It probably isn't a lion. It's probably the wind or a small animal or something. But there's a chance that it's a lion. And so if you don't run away in fear, then eventually you'll be taken out of the gene pool, or the odds mm-hmm. of you being taken out of the gene pool and not passing on your DNA are higher, and vice versa. On the greed side of things, if you see all the people in your tribe running towards something, maybe an animal just fell off a cliff and you can cut up its meat and eat it, or maybe it's nothing, maybe it's just a rumor that there's something to eat or some berries or whatever. But if you're like, nah, I'll pass on this one, then you'll miss out on the occasional meal and not be as well nourished or not survive the famine, and you won't be in the gene pool. So being, it was totally conducive to your survival to be fearful and greedy, but it's the exact opposite of what you need to succeed in the stock market. So, mm-hmm. The people who are really, really successful are just wired a bit differently. Either they've taught themselves to be wired differently, or they are wired differently. I heard an interview with the late Daniel Kahneman, who sort of showed us that losses hurt more than gains, and that's why mm-hmm. we're poor investors, among other things. That he continued to make the same mistakes. So even someone as smart as him, someone who pioneered the theory, continued to make the mistakes. Knowing about the mistakes is not enough to stop committing them. It does help, but knowing about them, you haven't achieved victory. You're 5% towards victory. The victory is basically sort of, and I'm like most people, I'm fearful and greedy. And so you want to insulate yourself from doing anything, from making, you want to have I guess Warren Buffett has this sort of punch card theory where mm-hmm. you have a certain number of punches that you can execute to buy or sell a stock, a very limited number of things. Well, then you're going to think much more carefully about it and not act that way. What I learned in the course of the book is there are other things that come into play. I understood those pretty well, but then the kind of the gambling aspect of it, I did not understand. So Robinhood, they'll deny this. They had all kinds of things going on. They built an app first, and then they tacked a broker onto the back of it. The app that was unusual. Fidelity and Schwab and everyone else had an app that worked, and you could buy stocks. But Robinhood designed a great app where they had all the principles of sort of, being very frictionless and having interesting fonts and confetti, but only mm-hmm. occasionally. Mm-hmm. That's the theory behind intermittent rewards, is that you create addiction by rewarding people randomly, mm-hmm. not consistently. And they were, and they are, and these gambling apps too. There's a gambling epidemic among young people in America, or all people really. They are very cleverly designed to keep you engaged and to make you addicted. And some percent of the population already has a propensity to be addicted to gambling, a not insignificant percentage, millions mm-hmm. of people. And the app-based brokers, the app-first brokers have the same exact design. And I don't think that it's a coincidence. I mean, they will deny that it's intentional, but down to the colors and the fonts and everything. They were Robinhood was sued over the use of confetti and stopped doing it. So it's there, and then the zero cost fallacy, as we talked about, other things. I mean the and the commercials that the brokerages have. You mentioned a truck driver who was trading stocks all the time. Well, eBay had a very memorable commercial during the dot-com boom, where some stockbroker is broken down to the side of the road and wearing a suit and tie undone, and a truck pulls up, and he says, "Oh, thanks a lot." And he's reading Barron's magazine. He said, "Oh, you're in the market?" Kind of arrogantly. "Yeah, I dabble a bit." He's trading on eBay, goes, "Oh, what's that you got there?" It's a picture. Like, "Oh, it's an island I bought." It's really a country technically, and I just do this for fun to help people out. So, the truck driver who, started trading stocks on E-Trade, I think it was an E-Trade commercial, had made enough to buy an island. It was way wealthier than the arrogant broker who was broken down on the side of the road. So, and there are many commercials like that where you can do it, you can outsmart people, but that's very tempting to people because the stock market seems very easy, and you don't really need a lot of IQ to do well in the stock market. It isn't that complicated either, because you don't need to do all the analysis. You can outsource it. It's never been cheaper or easier to outsource things, and but or to just buy a bunch of ETFs and forget about it. That's a beautiful strategy. You'll beat 85% of people if you buy a bunch of index funds and forget you own them, or check them once a year, every few years, and reinvest the dividends. But they make no money. And so that's the irony, is you can beat Wall Street. Like, if you really don't like Wall Street, I don't dislike Wall Street. I used to work on it. I work at the Wall Street Journal. They buy all the ads in the newspaper and my newsletter. Wall Street's good. They put food on my table. I don't like or dislike Wall Street, but if you really don't like Wall Street, the way to really hurt it is to take part in this revolution of investing being very cheap and very easy, where they're making, just 0.03% on your stock fund. They don't make a lot of money on that. And so they have to create products and excitement to lure more people in. One of the many ways was these app-based brokerages that got people to be very active, because even though they paid no commission, they were paying. They were paying indirectly.
It's the big difference between owning businesses, letting them compound, and seeing your money grow very slowly, and trading just for the sake of activity that makes somebody else rich. Buffett has this fun anecdote. He says that people come to him and they say, "I want to do what you did. I just want to do it faster." And I think that's, I think there's a big revelation that we all want to get rich. We just want to do it faster, and the market will teach us a lesson. But speaking of lessons, something interesting happened in April this year. I was actually catching a flight, and I don't usually check the prices of my stocks daily, but I opened my laptop and in the corner I see all those stocks collapsing. The memorable Liberation Day, and I thought, I think there's something off with my, because there was nothing I could think of that could cause the stocks to go down, which is obviously happens anyway. I looked and we had this big announcement. The point is that there are quite a few stocks that have no profit. There are kind of few stocks that are very much like the meme stocks that are doing extremely well. Is the same thing happening all over again? Are we past this craziness that happened 5 years ago? What's your take?
No, we're not. And that is the most surprising aspect of this whole thing to me, that I wrote this book. I worked very hard for it to come out on the anniversary of the events, so people would still be talking about it. I didn't think that we still would be talking about it as a phenomenon. I thought it was a kind of a flash in the pan for the most part. And no, we've had several resurgences of the meme stocks. And I would just cast the net a little bit wider, not just meme stocks, profitless stocks that have little to no intrinsic value,
Mm-hmm.
but also profitless things that have little to no intrinsic value,
Mm-hmm.
fart coin or whatever,
Mm-hmm.
there are all these things that are just shiny objects. I mean, at least a tulip bulb looks nice, right? These are things that are, don't even look nice. It's just a digital something, and you're buying it because the line is going up, and you want to sell it to the next greater fool, and that's your strategy, which is obviously, in the end, will end in tears for someone. You might make money. I'm not saying you can't make money if you have a perfect sense of crowd psychology. But that's very difficult to do, certainly very difficult to do on any consistent basis. Yeah. And so there are a lot of people who play that game who perfectly well understand, I think the majority do, that these things have no value. There's some
Mm-hmm.
people who naively think that they do or don't understand or suspect they might, and they see other people buying them.
Mm-hmm.
But there are a lot of people who are just doing it on the greater fool theory, because that is how you can get rich quickly. Very quickly, or go bust quickly, is latching onto these things. You can also go to Las Vegas and put everything on red 36 and get rich very quickly, but you probably won't. But that's in the short run, it's a repeatable exercise. It's also the short dated options boom. It was done as a way to manipulate the meme stocks, but then it has taken off. The amount of turnover in short dated options is off the charts. Your readers who know about financial history, or who read Reminiscences of a Stock Operator,
Mm-hmm.
which is a kind of lightly fictionalized tale of Jesse Livermore. He's Larry Livingston in the book. He's the boy plunger. He made a lot of money in something called bucket shops, and bucket shops were a real thing. They were all over the country, all over the United States, soon after the telegraph was invented, where you had these. They weren't really brokerages, but they were
Mm-hmm.
shops where you could, with very little money down, there's basically like a futures contract where you got wiped out very quickly. For a small amount of money, less than the value of a stock, you could bet on the next movement of a stock. And it was a really profitable business, kind of a dirty business too. But he managed to make a lot of money in these bucket shops because he had he was a savant in terms of understanding the direction of the ticker tape. They weren't really buying the stocks. They're basically, that's why they're called bucket shops. They're bucketing it. And this options phenomenon is actually very similar to the bucket shop phenomenon, because in most cases, no one is buying anything. You're just entering into a contract indirectly with some options dealer who isn't doing anything until the stock price starts to rise close to the strike price. Then they have to buy it. But otherwise, they're just getting to an agreement with you, and the odds are extremely high of the money you put down just expiring worthless, and you do it again. But since it's such a small amount of money, psychologically, it has this lottery ticket aspect to it, and people play the lottery too, and that's a very successful business with very poor odds. So, and so all these things I think are. You could just draw a Venn diagram, and they mostly overlap in terms of the people who get interested in it. But now it's become much easier to do. And of course, everyone's talking about it, and then there's all the classic bubble behavior, which is there really is something there. If you talk about AI or quantum computing, or you go back a little bit before to 3D printing or whatever the fads were before, there always is something that's grounded in reality. It's a real thing. You can see around you. You can see it, the technology emerging and changing things around you. And so you're sure that it's real. But you can also be pretty certain that once it gets big, once everyone knows about it and people are investing in it, that the majority of investments in that thing, we talked about Amazon, right? The internet, Amazon almost went bankrupt. Amazon raised money at a very unfortunate time.
Yes.
Otherwise my mom would have lost all her money. It wouldn't have been, would have forgotten that she lost it, but they had they not gone out and raised money right when the window was still open, they would have gone bust too, as brilliant as Jeff Bezos is. I mean, he is very smart, and whatever, he would have bounced back and done something else, maybe not as big, but most of those companies went bankrupt, and the internet's real. We're talking on it right now.
Yeah. Incredible. As I was listening to you, I was thinking how a lot of things have a price, a lot of things trade, but it doesn't mean that they have value. And I noticed that in conversations, for some people, that difference between price and value is obvious, and I don't have to explain. And for some folks, I think the concept just escapes them, and that's all right too. But if you go home and you go shop or you do anything in your life, you always do the math between price and value. My grandma did it shopping for carrots with me at the farmer's market. You do when you go buy a trip with your family, you're thinking, am I going to get more value out of this than I'm going to spend money? You told me about shopping for a microphone. You think the same way, right? Like intuitively, we know what the price is, what the value is, and we accept or not accept the price. Then we go invest and we somehow forget that very simple but very profound truth. I'll leave it at that. I have one quick question about risk takers that rise to the top of the feed, because I noticed that among professionals, right, we see those folks that have an incredible, very short-term track record and we feel like they figured it out. We see it among those new market participants we talked about. But with social media, you mentioned how certain voices that attract the most attention are not the wisest ones. Can you just share that?
That's right. Yeah, I should have mentioned that before when I was talking about social psychology aspects of investing that I had not appreciated. I knew all about the prospect theory and things like that. But, I naively thought at the beginning of this episode that this is just an amped up version of Yahoo message boards circa 1999. And they're not, because social media is built on algorithms of various kinds. And so they want to surface the content that most people like, and then other things are buried. And so you think about this, Bogomil, if you're kind of very thoughtful and sober, and we're talking about whether to buy a stock, and you're saying on the one hand there's this, and on the other hand there's that, and I took a look at it, and here are the pros and cons, and you go into a really cerebral analysis, and then I go, I just mortgaged my house and sold all my possessions and heavily margined myself into the stock. Let's go. I'm going to get much more attention because I just did something stupid and reckless. And then if I make money, especially, or have made money before, then I'm going to be followed much more. Now, am I the one to follow, or are you the one to follow? You're obviously the one to follow. You're taking a cautious cerebral approach, but that's boring. I'm not boring. I'm exciting. And I happen to make money. So there's the social proof aspect of having to, at least recently, made money. But I might not be telling you about all my failures in the past, or you might not care about that. I just made money in this thing. And so when people turn it in 2020, especially to social media, overwhelmingly to get their investment advice, people are like, how do I invest? Where do I learn to invest? These, quote unquote, finfluencers were telling them what to do, or they were just aping, it was like the movie and the TV show Jackass, where the more reckless stuff you did, the more attention you got. People love that stuff. It's like seeing a narrowly averted car wreck, right? And so you love seeing people do that, and you tend to imitate those people, or admire them at least, and take their advice. And so, there's this potent mix of social media, these app-based platforms that made it very, very easy to act on. I spoke to the investor behind StockTwits, who also happened to be one of the original seed investors in Robinhood. And Howard Linzon was really interesting guy, interesting career, ran a hedge fund for a while. And, he saw the money-making potential in it right away. And he wanted to integrate them. He went to these brokers before Robinhood existed and said, I'd like to integrate StockTwits or something like that into your brokerage so that people can talk about all these stocks. And they said no. There's a liability issue, but they said no. It would have driven more turnover. If you're Schwab, you don't care that much about the turnover. Your business is based on people who have a lot of money, who don't want to feel like they got burned, and you're making money on their cash balances or whatever. If you're Robinhood, and at that time their median customer had $241, the only way you're going to make money is if they're active and reckless. And so they didn't integrate the two. But I have noticed recently that a lot of the brokers, I think they do too, I'm not sure, but other brokers like Webull have whole social feeds in there, where you can discuss things. And it's not it's not you. It's not like the sober, analytical, cerebral discussion of the stock. It's kind of more reckless stuff or hearsay or outright wrong things, or misunderstandings. So so that also very much played a role and continues to play a role in markets. And of course, and then of course it also plays a role for people who are cynical, who want to manipulate markets. I mean, you don't know how much, especially with the rise of AI, you don't know how much of the traffic on a social network pumping the latest hot coin is basically a bunch of bots. It's full of bots, and bots are very cheap to create. I mean, you don't even need to go to Bangladesh and hire someone anymore. You just have somebody who, with an avatar who writes in full sentences if you want, who will post a bunch of stuff about the latest, greatest meme coin, so taking advice from social media is dangerous, but it definitely played a role in this meme phenomenon.
I see it as a lot more noise in a world that's already very noisy, but I'll leave it at that. I think I'll leave it at that. Anyway, Spencer, I have one last question. I really enjoyed this, and I have a million more, but we have to wrap it up somewhere. I'm curious about your definition of success. How do you think about it? Many careers, many lives, 3 decades, many interests. How do you think about success in whichever way you want to take it?
It's funny. I won't name names, but I was invited when I worked in the kind of emerging East. I worked with a handful of guys who've all gone on to be extremely wealthy, like for doing different things. Like a couple of them, I think, are billionaires. One of them is certainly a centimillionaire. And I was invited to a presentation in New York by a guy who had not been as successful, but who had known them and really wanted me. I was a journalist by that point, to come and attend his presentation. So as a favor, I did. It was a block from my office. I went and attended. And then, it's one of these, I don't think he was trying to be hurtful. It's just one of these kind of, I guess he was a little bit of an Asperger's guy, and wasn't really thinking in terms of, hurting my feelings. And he introduced me to someone and he said, "Oh, this is Spencer Jakab. He worked with X, Y, and Z. They went on to be really successful." I'm standing there like, and I'm the schmuck who went into financial journalism with a 90% pay cut. It was just the weirdest thing to say. And, I thought about it like, I think I'm at least as successful as they are because I have a good family life. I have a job I like to do. If I won the lottery tomorrow, I would still get up and write this newsletter. I'd go on nicer vacations or something like that and worry a little bit less about the stock market, but that would kind of be it. And so, to me, that's success is, having people who, admire and trust you and whatever. And I think Warren Buffett, said very similar thing. And obviously he doesn't have to work. He's retiring this year, but he does not have to work and hasn't had to for many, many, many years. And, his definition of success is having people who admire you. And the day that you pass away, people legitimately saying nice things about you, not just because you were some prominent person. Yeah. So, that's success. It was just such a funny moment that he was kind of the person was like, felt very awkward too, who he had introduced me to, that clearly I was the exception in this group because I had not gone on to make, $200 million or whatever. So yeah, that was funny. It made me think about that.
Well, I love the sound of that. And I think it's a revelation that I have with a lot of guests that tell me that they found something they really love. They have fun doing it. Buffett is no longer showing up, has not been showing up for the money for the longest time. He just loves the pursuit. And I think he loves that he became a teacher to a lot of us. And I think you are also introducing people to some concepts and ideas that maybe they're too far into them and too difficult to approach directly. And your newsletter is bringing them on board. I think the more of us know more, the better. And there's some mistakes that we talked about today that I think are just worth avoiding, and not avoiding the whole stock market, but avoiding certain behaviors that I think become very obvious after reading your book and listening to this conversation. And I hope people walk away with that kind of mindset and realization from it. That's my hope, but we seem to be making the same mistakes again and again. Thank you so much for today. What a pleasure to have you on the show.
Well, thanks so much for having me.
Before you go, just a quick reminder, If you want to check out Fiscal AI and see how it can upgrade your research process, subscribe using the link in the show notes to get a free 2-week trial plus 15% off. You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.